Credit scores. We've all heard of them. A number you can find in Experian, ClearScore, and other well-known sites. Most people try to improve their credit score when they need the credit, like when they're financing a car or buying a home, by which time it is normally too late. Mastering it, and mastering it young, can help save you life-changing amounts of money. So what is a credit score? A credit score is a way that lenders know how well you repay money that is lent to you. Even if you're good with your money, if you've never owed anybody a penny, you'll need to build a good credit score, as lenders will otherwise have no idea how likely you are to pay them back. Take a mortgage, for example. Imagine you get a loan worth £100,000. You repay the bank the £100,000 loan, plus interest, in smaller monthly payments over the next 10 to 30 years. The bank here is the lender, and the lender wants to know whether you will be able to repay the mortgage consistently for the length of the loan. So how would the lender know whether you are likely to pay it back? That's your credit score. It gives the lender an idea of whether you're likely to repay your loan on time and in full every single month. So by now, some of you may be thinking, so what if lenders know if you can pay money back on time? What's in it for me? Well, a lot actually. Having a high credit score can also give you the best interest rates on mortgages, credit cards, and loans. Having a bad credit score might mean you'll pay much more money in interest, or you could even be ineligible for these loans. Paying higher interest fees will ultimately make you poorer. You receive the same loan, but you might be paying back a lot more money. For your own examples, you can Google mortgage repayment calculator, taking note of the total cost of mortgage. The total cost of your mortgage can be tens of thousands of pounds higher when you have a poor credit score, as shown in the example. It's also worth bearing in mind that a poor score may make you ineligible for renting, and utility companies may put you on a prepay account instead of paying in arrears. For those looking for a sudden boost in their credit score, if you haven't already, sign up to the Electoral Register. This allows lenders to verify who you are, helping avoid problems with fraud, and it helps confirm the accuracy of the details you provide them. Hopefully by now you know the importance of having a good credit score, and how it can save you a lot of money if you plan on taking out a loan or a mortgage. We'll now go through 5 important factors that can affect your score. This information should help you in the long term, as you'll get an idea of how your credit score is broken down. Factor 1. Credit applications. When you apply for credit, be it a new bank account, credit card, loan, or any other type, the lender can conduct something called a hard search on you, which will temporarily lower your score. Even if you're rejected, the hard search will stay on your report for around a year before it gets removed. If you're thinking of picking up a loan or mortgage, try and avoid opening an account within a year of your application. Just remember, your score will bounce back from these searches in time, but until then, it may have an effect on your interest rate. Factor 2. Missing payments. A rather obvious one, but if you miss a payment, it'll hurt your score a lot. So always make sure you can afford to pay your payments in full each month. Missing a payment can lower your score for up to 6 years, so never take out a loan that's more than you can afford. We'll talk more about taking on affordable debt in part 2 of this series, where we teach you basic credit card principles and how to improve your credit score for free. Factor 3. Maxing out your credit limit. If you own a credit card or have access to an overdraft, try not to reach the limit, as lenders may assume you're in financial difficulty. They'll also assume you're in financial difficulty if you apply for too many lines of credit at one time. Factor 4. Length of your account. A little less known, but the average length of your accounts, be it a bank account, credit card, loan, or mortgage, all have some influence over whether you're likely to get chosen for a loan. However, it's worth bearing in mind that it isn't something that'll make it or break it for a lender, so don't worry about it if you find a good deal and decide to switch accounts. Factor 5. Employment status. Now, we aim our videos at young adults, so you might not have a stable income if you're at university or if you're just starting an apprenticeship. But when applying for a longer term loan, lenders like to see a stable income with a low debt ratio, so bear that in mind when you're applying for a loan or a mortgage in the future. So there we are. We've covered an introduction to credit scores, why they're important when it comes to saving you money, and 5 factors that can affect them. Be sure to watch part 2 on our Only Pounds YouTube channel, where we teach you how to use credit cards to build a strong credit score. Please like, subscribe, and leave a comment sharing your current experience with your credit score and what site you use to check it. And remember, here at Only Pounds, our mission is to expose young people to financial education. We are not your financial advisors, and it is up to you to continue researching the best options available to you. We do our best to provide information that our viewers can look into and build upon. Catch you guys soon.